Have you ever noticed how the market loves a shiny object? We spend all our time talking about chips, software, the cloud, the intangible stuff living in the ether. But occasionally there's a moment where the old world and the new world crash into each other.
That intersection is usually where the real money is made. It's not just about the code, it's about what the code actually moves in the real world.
Exactly. And today we are looking at something that moves. Literally. It's big, it's heavy, it's loud, and surprisingly, it's becoming incredibly high-tech. We are talking about Oshkosh Corporation, ticker symbol OSK. But here's the catch, and this is why everyone listening needs to stay tuned. The charts are screaming breakout, but the strategy right now is actually to do nothing.
Nothing? That's a bold way to open a show about an investment opportunity.
It is. But it's the difference between gambling and trading. We have a company hitting new highs, institutions piling in like crazy, and a valuation that looks like a mistake, it's so cheap. But if you buy right this second, you might get burned. So the question is, how do we play a stock that is perfect on paper but extended on the chart?
That is the classic trader's dilemma. You see the train leaving the station and your instinct is to run and jump on. But our job today is to explain why you should let it go a few feet further, wait for it to slow down, and then step on board.
Precisely. We're going to break down the massive institutional money flow we're seeing, the tech shift happening at CES 2026, and most importantly, the specific price levels you need to watch. Let's start with the big picture. Why is a company known for garbage trucks and military vehicles suddenly a growth story?
It comes down to a concept called GARP, growth at a reasonable price. Right now, the market is expensive. Finding value is hard. But Oshkosh is sitting there with a PEG ratio of roughly 0.76.
For those who don't live in spreadsheets, break that down. A PEG under 1.0 is the holy grail, right?
It is. The PEGI ratio compares the price-to-earnings ratio to the growth rate. Usually, if a company is growing fast, you pay a premium. A PEG of 1.0 is fair value. Anything under 1.0 means you are paying less for that growth than you should be. It's like buying a dollar bill for 76 cents. Oshkosh is trading at roughly 13 times earnings, but they're posting double-digit growth.
And that disconnect is what the smart money has spotted. I was looking at the institutional data from December, and it is staggering.
It's not just buying, it's accumulation. We're talking about massive players. Amundi increased their position by over 600%. Gabelli Funds is up almost 150-fold. When you see funds of that size increasing stakes by triple digits, they aren't day trading. They are positioning for a long-term re-rating of the stock.
That's the signal. Retail investors look at the price today. Institutions look at the price next year. But what are they seeing? Is it just that they sell a lot of fire trucks?
That's the base, but the catalyst is technology. Oshkosh isn't just bending metal anymore. They are debuting advanced autonomy, AI, and electrification tech at CES 2026. Think about it. Autonomous postal vehicles, electric fire trucks, AI-driven defense logistics. They are future-proofing heavy industry.
It's fascinating when you think about the societal layer of this. We assume AI is just chatbots or image generators. But the real disruption happens when AI can drive a 10-ton truck through a combat zone or navigate a fire engine through traffic. It changes the labor dynamics, the safety profiles, the efficiency of the entire public sector.
It does, and the market is finally realizing that OSK isn't a Rust Belt stock, it's a technology integrator. That's why the sentiment is so positive right now. Even with some analysts tweaking price targets, the consensus is overwhelmingly buy.
Okay, so we have the fundamental case: cheap valuation, high growth, massive institutional backing, and a sexy tech story. I'm ready to buy. Why did you tell me to do nothing at the top of the show?
Because of the technicals, we have to separate the company from the stock price. The company is great. The stock price right now at roughly $136.71 is what we call extended.
Meaning it's run too far, too fast.
Exactly. Look at the charts. We've had a 3.4% move recently. The RSI, Relative Strength Index on the 4-hour chart, is pushing near 70. That's the overbought danger zone. The price is stretched like a rubber band away from its moving averages. If you buy here, you are chasing. And in this market, chasers get punished.
It's the fear of missing out, right? You see the green candles, you see the news about CES, and you hit the buy button. But you're saying the math doesn't support an entry here.
The math says the risk to reward ratio at 136.71 is mediocre. You're buying at the ceiling of the current move. The smart trade, the swing trade, is to wait for gravity to do a little work. We need the stock to cool off.
So we are stalking the stock. We are the hunter in the bushes. What exactly are we waiting for?
We are waiting for a pullback to the breakout zone. The stock recently broke out of a consolidation phase. The ceiling of that old phase was around $134 to $135. Now that we've broken through, that ceiling should become a floor.
Classic technical analysis. Resistance becomes support.
Precisely, we want to see the price dip back down into that 134 to $135 range. We want to see it touch that level and hold. That is the sweet spot. That's where the risk is low and the upside is high.
It requires so much discipline. It's almost philosophical. The ability to sit on your hands when everything in your brain is screaming, action. It reminds me of that idea that trading is 10% execution and 90% waiting.
That's the hardest part for most people. They want the dopamine hit of the trade. But look at the data. If you enter at $134.50 instead of $136.70, you aren't just saving $2. You are drastically tightening your stop loss. You are doubling your potential risk to reward ratio. You're moving from a gamble to a calculated business decision.
Let's talk about that swing time frame. We aren't looking to hold this for 10 years, but we aren't flipping it in 10 minutes either.
Right, this is a swing setup looking at a 3 to 15-day horizon. The daily and weekly charts are beautifully bullish. The trend is up. We just need that 4-hour chart to reset. We are looking to ride the momentum from the CES catalyst and the sector strength. Industrial stocks are hitting new highs to push OSK toward its yearly high.
And the risks? Because no trade is a guarantee. What could go wrong here?
The biggest risk is the broader market. If the S&P 500 dumps, or the industrial sector, XLY, rolls over, OSK will likely go with it. Also, we are approaching the yearly high of roughly 144.30. That is a natural wall. Traders will take profits there. If we buy at the top now, and it hits that wall and rejects, we are underwater immediately.
That's why the pullback entry is so vital. It gives you a buffer.
Exactly. If you buy at 134s and it goes to $140, you've made a great return. If you buy at 130 cents and it rejects at $144, you barely covered your coffee money before the slide back down.
It's interesting how this connects back to the institutional activity. Do you think those big funds, Amundi, Gabelli, are chasing the price at $137?
Absolutely not. They are the ones putting in the limit orders at $134. They are the liquidity providers. They wait for the retail traders to panic sell on a dip, and they scoop it up. We want to trade like them, not like the crowd.
So let's synthesize this. We have a company that is fundamentally undervalued. We have a narrative, the tech transformation, that is just starting to get attention. And we have a technical setup that requires just a little bit of patience.
That's the summary. It's a wait, then pounce strategy.
I want to dig a little deeper into the CES aspect before we get to the specific numbers. You mentioned future-proofing. There is a deeper economic theme here. We are seeing a lot of capital flowing out of pure software plays and into real stuff. Is OSK a proxy for the reindustrialization of the economy?
That is a great observation. There is a rotation happening. People realize that you can't live in the metaverse. You need trucks to deliver goods. You need construction equipment to build data centers. You need defense vehicles for geopolitical stability. But, and this is key, investors demand efficiency. They won't buy dumb iron anymore. They want smart iron. OSK is proving they can make smart iron. That expansion in their multiple, that PEG ratio, moving from 0.76 closer to 1.0, that is the market rewarding them for becoming a tech company.
It's the convergence. And convergence usually creates volatility, which creates opportunity for swing traders.
And that volatility is what we are trying to harness. The 4-hour chart shows strong momentum, ADX is rising, but the RSI is cooling. That divergence is our entry ticket.
All right, I think we have built the case. The listeners are sitting on their hands. They are watching the ticker. They know the why. Now they need the when and the how. Let's make this actionable.
Let's do it. This is the game plan.
Step 1 is the entry. We are not buying at market price right now.
Correct. Do not buy at 136.71. You need to set an alert or a limit order.
Give me the specifics.
When to invest, you are waiting for the price to pull back into the $134 to $135 zone. This is the retest of the breakout. Do not just blindly buy. Look for a 4-hour candle to close green in that zone or show a rejection of lower prices. That is your trigger.
Okay, so we enter at $134 to $135. Now, protection. Where do we get out if we are wrong?
Risk mitigation, your stop loss goes at 129.50 sounds. This is critical. If the price closes below 129 or 50 on a daily chart, the thesis is broken. It means the breakout failed, and you need to leave the market immediately to protect your capital. That's roughly a 3.5% risk.
And the fun part, where are we taking profits?
When to leave profit, we have two targets. Target 1 is the yearly high at $144. When we hit that, you should sell some of your position or move your stop loss up to break even. If the momentum continues, target 2 is $152 based on analyst structural targets.
So, entry, 134, 135 stop, 129.50 target, $144 first, then $152.
That gives you a risk-to-reward ratio of about 3.5 to 1. That is a professional trade.
Excellent. There you have it, folks. The Oshkosh opportunity isn't about chasing the noise. It's about waiting for the signal. Watch that $134 level.
Patience pays.
Thanks for listening. We'll see you on the next pullback.